Eugene, thank you so much for joining us today. Let's kick off with a view on the luxury goods space today, because I don't know if you've noticed, but Richemont's stock down almost 5%, 4.6% in the red. It's all been about Burberry and the concerns around not hitting sales forecasts and lower profitability this year. That stock down 20%. But as one analyst said, you know, trench coats are not watches and jewelry. So all products aren't the same across these luxury goods commentators. Do you think a downturn at Burberry signals a downturn for Richemont's earnings?
I think if we look at Richemont's earnings and the trading statements that recently, it wasn't too bad, but I think the stock just simply ran way too much. The recent trading statement, European side, was actually doing very well, and they believed it was coming from Asian and other tourism. The Asian side much softer, and I think that is driving the sentiment in this market, is the softness that we're experiencing from Asia is slowly but surely flowing through the market, and it's normalizing things. So maybe a little bit of an overreaction on the Burberry side, but in terms of Richemont, I think maybe just a healthy pullback. The stock is not cheap at all.
Yeah, I mean, it has had a strong rally to above 50 Rand. Let's talk about First Rand stock, 27 Rand 50 at the end of trade today, up 1%. Firstly, starting with F&B, I mean, fantastic performance. ROE sitting around 37% right now. What are your thoughts on those numbers coming specifically, if we had to break it down, starting with F&B?
Okay, so fantastic numbers. F&B doing extremely well. They're growing assets, which is very important. We haven't seen any substantial asset growth on the banking side. I'm not talking Westbank here at all. The asset growth, maybe not that magic on the home loan side, but the asset mix is fantastic. They've optimized that. It's flowing through into the numbers. The credit ratio is picking up a little bit, but that's well explained. If you drill through the numbers, the credit experience is fairly good. We know that we're at the bottom of the credit cycle. So I think recent campaigns, the amount of accounts that they added all the way through, F&B has done fantastic.
I mean, when it comes to RMB, the RMB and global transactional services contributing around a third to earnings, but those earnings are contracting by around 5%. How would you assess the performance of this and the likely increase in earnings going forward, in light of the fact that we're seeing all this volatility, and we're also seeing the fact that they've had to close certain parts of the business, for example, the proprietary trading desk?
Okay, so on the corporate side, RMB side, they've re-engineered very aggressively, taking a lot of risk out of the system. It was an extremely difficult market, and if you compare them to their peers, I think what they've achieved was reasonably good. The re-engineering, taking risk off the table, was done in a very efficient manner, focusing the broader group. If you look at the broader group, they made a great effort and in focusing their business, bringing it more to a bank-like business, and that's linked to, for instance, the sale or unbundling of the insurance business as well. So RMB doing well in very difficult environments. The de-risking seemed to be working well. So yeah, that's okay.
Yeah, let's move on to the platinum sector, which is experiencing a lot of turmoil at the moment. On the one hand, you've had the platinum price, which has benefited a 15% rally last month, and it continues to trend higher. And then on the other hand, you've got demands for wages. You don't know what production is going to do, with the likes of Lonmin having shut production, Implats now having a second demand for wage hikes this year, which will effectively double workers' wages within 6 months. What would your view be on holding any of these stocks in light of those kind of push-pull factors?
Okay, so firstly, there's an enormous amount of emotion in this thing, and it's not something that's easily solvable. I'm really worried about it. It's a sector that 2 months ago was actually, from a valuation point of view, very attractive. It's getting more attractive if they can sort out the problems. it doesn't help to load these mines with these costs. They're just not going to survive if you keep loading these costs. You will not see investment, and it will eventually just result in job losses. So I'm really worried about this. If you asked me this question 2-3 weeks ago, I would have said it's a temporary type of thing. And it doesn't seem to be the case. It's spreading wider and wider, and I think the broader South African politics is playing a really, really important part in this. And I think this needs to be addressed on a government level now. You can't tolerate this. I mean, you can't negotiate out of the legal system, and so it's really worrying.
Eugene, we're going to have to leave it there. Thank you so much. I think that's a sentiment shared by all South Africans right now. Eugene Goosen, Portfolio Manager at ORA Fund Managers.